Market observations, Blacktown, Sydney, New South Wales. Now this is an area that has come from left of field. Okay, it's not on everyone's lips, it's not an area that we're all speaking of, but some interesting components of this area are outstanding. Some elements of this research demonstrate that Blacktown is one of the most compelling areas to be worthy of your consideration across the entire country. At other layers of this investigation and research, we can see that it might not necessarily be the best location or time to invest there. So it's a very interesting case study. You'll learn a lot today about how macro analysis feeds into mid-tier analysis, into suburb, and then micro analysis around street level analysis. So I'm going to be, basing this on a lot of your feedback around let's focus on the suburban street area. Let's really dissect this as locals will, because this is the theories, this is the practice we need to implement in other areas that might be worthy of our attention. So let's dive in. Blacktown, New South Wales. Before I jump into this, if you've liked this or our previous videos, then please feel free to jump into the 25-minute explainer video below. It's free, it's packed to the brim with private research and interesting theories and strategies around the exact properties that we are buying right now for friends and family. I must remind you, I always have this slide here, property investment is a science. Okay, there's some subjective elements, there's some emotional elements. Our job as investors is to remove the emotion and replace it with science, data, and accurate decision making. It's a formula. We look at the demand side of the equation, we remove the supply, and we are left with the overarching opportunity. Think of things in terms of where we are going to be investing is the opportunity, the predicted performance. And then once we identify an area that has good predicted performance, we make sure we're buying in the optimum buying window. We don't want to be buying at the peak of a market or down in a trough when things are consolidating. We want to be buying just as the market starts moving in that hockey stick type growth period. That is our buying window. So today with Blacktown, let's firstly determine, is this where we should be focusing our attention? So let's assess the market opportunity. Element number one, employment. Extremely diverse on a national level, okay? 5 stars out of 5 stars. We have retail, trade, manufacturing here, transport, postal, and healthcare. Some big ticket items in the employment diversity and a breakdown of the area. Big tick here. Income growth is off the charts, extremely high over the last few years, very high in terms of suburb versus suburb, area versus area across the country. Some of the strongest income growth we have seen nationally in recent times. Big tick here. Commute time, generally, you would expect that to probably be a little bit larger in Sydney, but a lot of people in Blacktown actually live and work in the area, okay? So the commute times in Blacktown are actually very good, even when we know that Sydney generally has issues with commute times. Blacktown, a lot of people live and work in the area. Reasonable commutes, most people actually driving to work. So employment is very big ticks, looking excellent there. Let's have a look at the unemployment rate. It has peaked back up towards 7.5%. So a little bit of an asterisk. Remember the national average is around here. This is a little bit above it. It has been in the last 12 months. So there might be some impacts through COVID, through the recovery from COVID. We have to remember back into last year what happened with Sydney through COVID. So we might expect this to tighten back up again throughout this year, but this is a metric to be watched and observed. At the moment, with the overwhelming majority of figures on the employment landscape very positive, I'm willing to overlook this one bearish metric. So overall, employment very strong. New projects on the list. This is now when we start talking about capital city local government areas. We see big ticket items, $750,000. Okay, we see impacts where this is where businesses, we have to sometimes be wary of these projects, because whilst they're not actually being delivered in this area, their businesses are based in this area and there might be some operational elements. So we have to be careful where we assign our budgets. Transport New South Wales, good primary upgrade. Schools, hospitality, industrial, retail, hospitality. Overall, we are seeing, reasonable new projects, but when we divide it by per capita, it is only average. Okay, so this is not really the story for the area. Local services, we can see obviously Blacktown out here, Sydney CBD here. We can see a lot of localised services as we would expect, right, for this inner capital or mid-capital city region. We've got the main airport here of Sydney at Mascot, and we do know that we are looking at a secondary airport out in there in Sydney's west. So this accessibility is only looking to improve. We've got large base hospitals in and around the area. This is a very viable suburban location, all right? It is seen as probably middle class Sydney. You know, you've got the second CBD at Parramatta. Well, these arguments that Blacktown is emerging as almost another satellite CBD of its own right. It is a very diverse local government area, and that's probably something we'll highlight in a moment. There are pockets of Blacktown which are very predominantly high density unit type accommodation, others which are moving out into rural or larger block type areas, very low density. So we need to get this right when we are analysing these larger, broader local government areas with a lot of population in them. Local services, lifestyle, big tick, as you would expect, very good amenity on a national level. Population growth rate, national level, this is very good. Okay, this is around average at a national level, but it's good for a capital city. You know, this is the type of population growth that we like to see. We also want to check that there's no new supply coming in and ruining this party, but population growth is very strong in this market. You can see I'm skipping through this quite quickly. Overall, let's have a look at this formula very quickly. Excellent employment, average new projects, very good lifestyle population growth. Okay, excellent. New supply, let's have a deeper dive on the suburb level, but new supply in suburban, you know, working class suburbs of Blacktown is constrained, and I'll show you that on a map in a moment. Overall, when you weight these factors and you combine them together, remember when we combine these factors, Eric is probably predominantly responsible for that process with internally. He's a data scientist. He's actually got a master's degree in actuarial studies as an actuary. We know the weightages we need to apply to these macro factors, okay? It's not all employment. It's not all supply. We know the weightages to apply to individual metrics within this assessment. So remember at this point, we are considering, is this a good where to buy? Not when, but where. And when you take that consideration for Blacktown, it is in the top 99% of all areas across the country. Okay? If you line the best to the worst, there's only really one LGA or two or three LGAs in the entire country that potentially are stronger from a long-term growth perspective. You consider the where as a long-term measure. We are looking at macro factors, so the more broad these factors are, the longer-term perspective we are taking. This local government area, it really doesn't get much better than this. Okay, well, it's ticking on a lot of boxes, so the mid to the long-term prospects for this area are outstanding. When you compare this to the city of Brisbane, top 94% of all areas. All right, so we're even thinking that Blacktown has longer mid to long-term performance than the city of Brisbane. When you compare it to other areas in Sydney, inner west, neighbouring LGAs towards Sydney CBD, top 89% of all areas. So even compared to its peers, it is outstanding. All right, so that's putting it in context for us. Let's dive into, is this the when? Is this in the buying window for us to capitalise on this opportunity? So let's dive in. Days on market, red line is houses. That's where I'm focusing, very tight, okay? Very tight on a national level, 20 days on market, an efficient market. So tight, bullish signal. This is a concern. Competition has fallen off a cliff. Okay, this is going to give you some context in a moment, but we can see essentially since Christmas, since January, competition has really slowed down. And this trend, it's not an aberration, it's month into month downswing. Okay, so competition has really pulled off in the last 2 or 3 months. Stock inventory, we can see a build-up emerging in the last month or so. So a very strong tightening here, but as that competition has dwindled or the pressure has eased off the market, you can see that houses are being put onto the market faster than they're selling. Okay, so this is expanding, the market is unwinding, the pressure valve has been released. Days of remaining supply, it's still very tight. The houses is what we're looking for. You know, things are turning over, but the pressure is starting to be released from the market. So this is only one measure. Still a very hot market. It does need to be said, but it's now probably more a function of limited supply, not the demand side of the equation. We'll see that in a moment. This is starting to give you a picture of why that pressure valve might be starting to be released. You see the upward swing of property prices. There really weren't too many places that were better than this in the country. 850K up to 1.1 million as an asking price increase. This is a rolling 90 days number, okay, so it has some time lag involved in it, but we do like opening it up to that 90 days just so we can see a nice big chunk of sample size of reliable property sales to get, or asking prices to get that data. We can see since the pressure valve has been released that prices have stabilized. Okay, so this is arguably the peak in the market, right? Percentage asking price, percentage sale price above asking price. We can see right back here in middle of last year, this is when the market was really tight. You know, the snake was bound up. And as the year has gone on, we've had this pressure valve releasing down to a point where now properties are almost selling for what the asking price is. Okay, so this is further confirmation that we've hit a market peak and it's not likely to be a short-term aberration. This is now looking like it's entering into an extended consolidation period. These factors are all lending itself as confirmation of that trend. And this is obviously a function, okay, you've got asking price times by the discounting amount equals the sales price. Obviously, this is confirmation. You know, 2021 into 2022, look at this price growth. Well, the evidence here is showing that it's reached a peak. All right, so we've got the where, big tick there, but the market has gone through a very strong upswing, and it does look like in the last 3 months it is running out of steam. Let's have a look now at the rental side of the equation, because sometimes that can justify or demonstrate that there might be a secondary kick that's emerging into this market. Rental analysis. Days on rental market is dropping sharply, okay, very tight. Is this an issue with demand? Huge amount of demand swelling into the area, or is it just a very small number of properties available for rent? Okay, that's probably what we need to ask ourselves. Here, we can see it as a function of very limited supply, very limited rentals available for rent. So the underlying demand is still in question, right? But the stock on market from a rental side is limited. Remember, the rental side of the market a lot of times drives the buy side. So we look to the rental side to see if this peak in the market is temporary, if it's a short, you know, slowdown or consolidation phase before another uplift. Let's continue down this rental path to see confirmation here. Asking prices for rent have been increasing very strongly and steadily throughout this period. It has been about a 10% increase over that year period. Is this once again a function of demand or limited supply? So this is probably confirmation based on this slide that it is limited supply. What is the underlying demand? So, well, yields, before I get onto that, are very low. This is not investment grade as an area. I expect properties to pay for me to be in my portfolio, to pay me for the privilege of being in my portfolio. 2.5% yield, that is not investment grade. Okay, it puts a lot of emphasis and reliance and pressure on property price growth to bring you a return. Okay, this is not covering the mortgage repayments and outgoings, etc. It really does put the full emphasis on property price growth to generate a return on your capital. I have high expectations in this. So let's, in summary, and I'm going to jump into some suburb versus suburb analysis in a moment. In summary, excellent where. Mid to long-term signals are very good. The buy side of the equation is demonstrating we've already made a peak of the market about 3 months ago, and we're expecting a long-term consolidation period. The rental side of the market is showing healthy signals, but that's probably due to a lack of supply in the rental market, not necessarily demand driving that equation. And I'll confirm that in a moment, because and that's also further evidenced by low rental yields, but that's typical of the market. Okay, that's typical of Sydney at this higher price point, you know, $1 million, sort of $800,000 to $1 million properties. That is a yield that would generally be expected, all right? So I wanted to go to suburb versus suburb analysis to determine, what is that demand on that rental side of the equation, and is there any possibility of another kick on the buy side? So let's jump over here to suburb versus suburb analysis. Okay, just so we get our bearings, we're obviously targeting on the suburb of Blacktown in the local government area of Blacktown. I've chosen this as the centre heart of the area, and what we've got here is we've got each suburb in the local government area with a different coloured overlay. Obviously this is the border of the suburb, and then based on the percentage value or the value for that metric, we have then weighted or coloured the overlay for that suburb. This is called a heat map. It's very, I guess, effective at showing patterns and trends geographically. In this example, we've plotted recent growth, and we can see that this core of the market in the lighter pink has started to cool off quite quickly. You know, this is a 90-day rolling number, so we can see here that these suburbs have already cooled off 5%, minus 8.4% here in the last 3 months. Whilst over here, even in the one local government area, we do have pockets that are still moving. All right, so this chunk, you know, you can draw a line through the middle. This chunk has, I guess, necessarily gone back in value in the last 3 months, but at the same time, this chunk is still powering forward. Okay, sold price. You know, this is just showing where the more expensive or the cheaper pockets are. We can see this area here, which we can, if we remember just on the last slide, has gone backwards in value in the last quarter. Well, this pocket over here has been performing relatively strongly still, and this is the lower price pocket as we go further north. All right, so we're starting to see, you know, a relationship. Lower prices are still performing okay in this local government area. Where can we try and increase our 2.5% yields? You know, we've got our 2% yields here in the area that's not performing quite strongly. It really doesn't get much higher over in this area. Yields are still suppressed. We have one suburb here with 4.7% yield. I did dive into that, and that's probably due to a low sample size issue, not a huge amount of rental properties in the area. More broadly, this is, you know, I would make the assessment this is quite a flat terrain when you consider yields. We're not targeting or able to really target any pockets of higher yields. Even this lower price pocket, which is still performing quite well from a price perspective, has low yields at a $700,000 price point. This is not really cutting it for me. This is a bearish signal for me. I would like to see that lower socio pocket with higher yields to show there is still demand driving towards it. Vacancy rates is where things get interesting. Remember, I'm still looking for confirmation around another kick coming through. We don't have a huge amount of supply on the rental side of the equation. We have a nice tight rental market, but I'm still trying to work out, is there underlying demand? And this is really interesting because this is a very recent snapshot of vacancy rates in the suburb. This is a shorter time frame than the original slides that we looked at with the lines. This is what's going on in the market in very recent weeks. Okay, we can see vacancy rates in this pocket up to over 10% in Blacktown. This is for houses, by the way. This is not for units and houses combined. We can still see vacancy rates have pulled out here up towards 8 and 9% for houses. Okay, it's not to say units might be turning over more effectively. This is very concerning. This is showing that that's, you know, the positive signs in the rental side of the equation are due to lack of supply and not overwhelming demand. Okay, because some of the properties are still sitting around for quite a while if they're not hitting that mark. Okay, we have very patchy demand. This is a big concern for me, right? I like to see healthy rental markets. You know, we can see some suburbs here at 3%, 4%. That's okay. But this band through here of 6, 7, 8, 9% vacancy rates is a concern. All right. When we lower the time frames, okay, and we're only dealing with small suburbs, you can see here that you've got a 17% vacancy rate for this suburb. Okay, that might be a small number of data points to look at, and they're blown out because the sample size is so low. All right, we do like to open this out wider, but it does show and illustrate the point I'm trying to make. Broadly, vacancy rates in very recent times are quite high, over 3.5% across the LGA. Days of supply, we know this, all right? Extremely tight or very tight days of supply, but even still there are some suburbs through this tract here with extremely tight days of supply. Hopefully this type of analysis has been useful for you. For me, I'm not really seeing any confirmation or any confidence on the rental side of the equation. It's definitely in a market peak. This is almost the worst time to be buying in Blacktown. Probably the worst time was 3 months ago. This is, from what the data is showing, this is foreseeably the worst time to be buying in Blacktown at a short to medium term measure. We know that in the longer term, the predicted performance, the overall opportunity is very good, but the buying window is very bad for this area. So that's probably the overwhelming point. I wanted to, for your benefit though, dive into the suburb of Blacktown because it is probably one of the most diverse suburbs in the country. Okay, we see some extremes in this suburb that are very rare to see, and it is useful for our analysis. So this is, to get your bearings, clumps. So each one of these areas, these square, these polygons, these shapes, are 200 dwellings. Okay. At Ripehouse Advisory, we own all of our own data. We don't outsource this. It is key, it is a core competence of what we do. We feel we are market leaders in this field. Going back almost 10 years since we've been operating, we have been doing extensive street level analysis. We have to operate like locals do in every area across the country. We have to be buying in the best street pockets possible. We have to understand this terrain intimately so then we can capitalize on the opportunity. Blacktown is a very good example of it. I might start here at the property type. Okay, this is the percentage of houses. We actually have no houses through this pocket. This is where the shopping district are, very high density units. 2.6% houses here. Remember, that's only 5 houses in this pocket of properties. And as we go down to this area of the suburb, we have predominantly houses. You don't want to be buying a house here because it's surrounded by units. You don't want to be buying a unit here because it's surrounded by houses. You want to buy the most in-demand and common property type for that area so you're not left holding a white elephant. You can see that this whole sort of pocket through here is predominantly houses, a lot of units through here. We have to get that right when we're coming into these suburbs. Also, we've got 12.9% owner-occupiers here, right? Almost 90% renters. And we've got on the other end of the equation, 81% owner-occupiers down here, very few renters. So it's not to say one is better than the other. We generally prefer around that 2/3 of owner-occupiers. That gives us enough owner-occupiers in the market to deliver that, owner-occupier appeal, the value add, the pride in properties and the improvement, and drag up property prices with it. But we still need to have a number of tenants in the area to give that rental demand, okay? We can't be buying in an area that doesn't have any tenants traditionally because tenants might be avoiding it for a particular reason. So we have to get that balance right. This is definitely, too few owner-occupiers, but through this whole tract here is giving us an effective balance. So even in this suburb, where we don't have a value there, we don't have enough sales for houses. All of this data here now is for houses only in the last 3 months. So we don't have enough house sale data here, obviously, because there's none to sell. But you can see how prices change throughout a suburb. Once again, some of the cheaper areas through here, we have a few exceptions, but probably more broadly in the north of Blacktown is higher price pockets. When we look at a suburb median, we forget the subtleties, how price changes across a suburb. Okay, if we think $1 million is good value here, well, we're actually overpaying compared to next door, where $940,000 is the price median, and next door it's almost $300,000 cheaper. What is causing that? Okay, this particular data is over a year period, so we have to pull out the time frames because the sales on a smaller level are fewer. Okay, so we have to pull the time frames out to get accurate data. But when data is changing between $300,000 here or there, we're really starting to try and work out what is going on. Okay, a bargain here is potentially extremely expensive when you consider its neighbours, or vice versa. Let's have a look at the rental terrain, because this is really interesting. As we go down into this pocket here, prices are more expensive, but you can see that rents are also increasing along with it. So this particular band here is, higher in asking rent than these bands through here and over in this pocket here. We've seen a patch of nice strong rents per week over in this southwest corner of the suburb, and we combine that together, we can see this higher yielding patch of the suburb. This is for houses, once again, houses to be avoided as an investor in the north, 2% yield. But if we are forcing ourselves to come into Blacktown, we know that typically it's a lower yielding suburb. We can still eke out 3.5% yields by targeting this pocket. We can then potentially even find unrenovated properties and value add, and then increase our yield on cost base variable up to even 4.5% if we do our job well. So we can sometimes make these suburbs work when we target particular pockets. Now I'm going to be looking or trying to look for reasons. Why is this price terrain so varied? So this one, we don't have the color variant on this one yet. We've got a lot of areas here with 0% public housing. So this is public housing per street area. So all of these dots are 0%. We can see almost 25% public housing, 26% public housing up here in the north. A lot of these units through this middle area, 8% public housing, not really a concern. Very few public housing enclaves down here, 1% public housing, 2%. The rest of them are all 0. So in this suburb alone, we can see the higher concentrations of public housing have a very high correlation to lower yielding areas, lower street appeal, okay, lower renting amounts, and more broadly, potentially no real correlation to price. We really are affected on the street level demand side. Hopefully this analysis has been useful for you. It does come to show you that there are pockets within pockets. Some of the analysis that we've done, we called a Ripehouse sweet spot. We are looking for the combinations of these factors which generate and combine together to deliver stronger than average growth across a suburb. We've worked out a combination of factors that deliver 25.9% above average returns compared to the rest of the suburb. So what I mean by that, it's not 25% extra capital growth in absolute terms, it is in relative terms. So if the suburb goes up 10% for the year, you would expect the optimum sweet spot area to go up 12.5% for that same period, 25% above average capital growth. By the same tokens, when you don't get that street level factors right, it can potentially impede the capital growth that you deliver to yourself by up to 20% less than the suburb median. It's a little bit less on the downside from our research. You've got to get this right, okay? You've got to have the majority of the in-demand property type in your street, 65% or above owner-occupier levels. You've got to have above average rent and yield, and the low public housing percentages for that type of suburb. We combine all these factors together to find these sweet spot areas. We have to have this level of intelligence when we're entering into these suburbs. Okay, you want to be able to target where things are working in your favour versus when they are not. So in summary, we could potentially make somewhere like Blacktown work if we were forced to buy here by using this type of street level analysis, but we are fighting against the grain. We're fighting against the suburb, the local government area. It's not in the correct buying window just at the moment. So if you do like this type of analysis, it'll be great if you could subscribe to our channel down below. Hit the bell icon so you're the first to be informed of any new videos that we release. And if you think this type of analysis is useful, please join the comment section below, suggest other areas, give us some local insights if you're on the ground in this location, and share it with your friends and family. If you drop it into a Facebook group, that's awesome. It's much appreciated. It creates conversation in multiple places, and it shows people the light. This is all about education and empowerment. So let's draw some other audiences back over into this type of content. Share the video around. Hopefully this has been useful. Thanks for your time. Jacob Field signing out.